Hey there, Ken Zorvich, NFM Lending. Hope you're having an excellent start to your weekend. So, wanted to check in with you on a topic that has to do with data integrity and why we need to be watching this, maybe even concerned with it, because it plays a big role in how it impacts real estate, how it impacts mortgage rates, how it impacts our stocks, our bonds, basically our investment portfolios like 401ks, all of that. And I want to break it down for you a little bit. So, a lot of this information was courtesy of Bloomberg. And I found it fascinating because this is stuff that I follow on a regular basis. And they've been under a lot of scrutiny, and I'm going to show you why. Every month, the Bureau of Labor Statistics, or the BLS, puts out information that not only our stock market, our Federal Reserve, but most industries across the country and the world follow this information and this data for how they're going to trade and position themselves. So let me give you some examples. What the BLS tracks is it tracks census data like population growth. It attracts what they call a job index. It tracks unemployment rates. It tracks new job creations. It tracks job openings. And the way they collect this information is they do surveys every month to put out this data. And so they'll call people, they'll try and meet with people in order to get these surveys done. Now, I've never received a call from anyone for this. Maybe you haven't either. But this is how they gather the information. Then they apply statistics. So if anyone remembers taking that in high school or college, they apply statistics, and now we have what they project as their numbers for that month. Now the problem is twofold. One, the data is not completely accurate because they always make revisions, and that's understandable. It's not real time data that you have maybe in a software being input there. So it's surveys, it's statistics. There's going to be some corrections they need to make once all the data comes in, and they usually do that maybe about a month, sometimes 6 months, sometimes a year later. The other issue that's now risen on this and why they're under a lot of scrutiny is the participation rate is dropping drastically. So, for example, if you look at this graphic that I have here, look at where we were 10 years ago and getting people to respond to these surveys, and look where we are now. And people are giving common reasons why they don't want to. One, people just don't want to do surveys anymore, right? How many of you block a spam call or don't pick up a call? Two, people don't trust the government right now, and they don't want to trust the government with any information. And three, they're the people that are responding sometimes are flat out lying. They've seen this on online surveys that they've tried to do, and also with in person and over the phone surveys. So the way we're collecting the data is now, in my opinion, compromised. I don't think we can trust it anymore because of such a small amount that's kind of being a part of this survey. So why is this a big deal? Well, guess what? Every month when this information comes out, trillions of dollars all over the globe are being invested and positioned according to this information. The Federal Reserve is making policy according to this information. And so if I told you that in January, we're expected to get a revision that we overestimated jobs in quarter one of 2022, I'm sorry, 2023 to quarter one, 2024, if we overestimated that by 1.2 million, it would be a bit alarming, wouldn't it? And that's what we're headed for because of revisions. So the point is, this information that we all rely on has to change, or else we're going to make some big mistakes. And what are those mistakes? The Federal Reserve may keep interest rates higher for too long, be too restrictive, force us into some type of recession. Mortgage rates will stay high too long. It's going to affect the real estate market, so on and so forth. So the point is, keep an eye on this, because I think going into next year, what's really going to impact mortgage rates, it's not going to be inflation. If you follow inflation enough, you'll know that we're going to kind of be between this 2 to 3%, I think, for a little while. And then we'll eventually get to where the Fed wants to go. But what's going to really drive whether interest rates go up or down moving forward, especially into next year, is unemployment. And it's this jobs data that we have to be monitoring. So listen, I hope you found this interesting. If you want to reach out to me, talk about it, be more than happy to. Make sure you get in some time with some friends and family this weekend. And as always, I'd love to be in this business in 5 years. If you know someone looking to purchase or refinance, please think of me. Have a great weekend.